Good morning and welcome to the FASB ASB Liaison meeting this morning. When you think about accounting, accounting and auditing work very well together. And I think today's meeting, we have a chance to work together and learn from each other is a key part of that. Excuse me. My name is Rich Jones. I'm the chairman of the FASB, and with me today I have the entire FASB board. In addition, we have our technical director, Hillary Salo, as well as several members of our staff. In addition, we have Rick Reisick, who's here representing the PCC for us today. And with that, let me turn it over to my counterpart for today's meeting, Tracy Harding. Tracy.
Thank you, Rich. Good morning, everyone. Like Rich, I am a relatively new chair of the Auditing Standards Board. Became chair toward the end of May, succeeding Mike Sante, who many of you know. I am for those who I haven't met, I've met many of you, but I'm the quality assurance partner at Berry Dunn, which is a regional CPA firm headquartered in Maine. And I've been on the ASB since January of 2017. Also active with NASBA. I serve as the chair of the Maine Board of Accountancy and also on the NASBA Regulatory Response Committee, which drafts most of NASBA's comment letters on proposed standards and regulations and that sort of thing. So we're thrilled to have this opportunity to meet with you folks once again. We really appreciate your willingness to meet with us. I agree, Rich, accounting and auditing have, of course, a great deal of overlap, and our staffs have worked in preparation for this meeting to come up with topics that we hope will be of mutual interest. I am joined by the Audit Issues Task Force of the ASB, which I kind of think of as our executive committee. And most, if not all, of the ASB members are also observing this call, as well as a number of AICPA staff. So are you set on introductions, Rich? To jump into the agenda, or don't know if
we're all set here, Tracy.
Okay, great. We have a busy agenda, I know. 2 hours will likely fly by. I want to mention that, particularly as we go through the ASB update, we really do welcome any feedback you may have for us, and don't worry about whether the feedback is specific to the implications of our activities on accounting standards. We just got a whole bunch of really smart and experienced people, and if anything occurs to you as we're talking about our topics, we would really find your input valuable. So I'll jump into the first agenda item, update on ASB activities, and again, tried to pick those that might be of particular interest to members of the FASB. We did issue, as you may know, an audit evidence standard recently. This is something that we felt was important to modernize the auditing standards in light of a couple of things. Number one, emerging technologies. Our standards were focused on audit procedures, and audit procedures have changed as technology has changed, both technology used by auditees and technologies available to auditors. So we undertook it for that reason, as well as a recognition that there are more diverse sources of information available to auditors these days than there were when the standards were last updated. When you think about internet and social media and all of that may be relevant to the audit. So what we've tried to do in order to avoid it becoming, again, outdated soon, is primarily make it principles-based, and rather than focusing on audit procedures, focus on how the evidence, how the information received and converted to evidence by the auditor contributes to the requirement in the audit to obtain sufficient, appropriate audit evidence to form an opinion. So spend a lot of time talking about sufficiency and appropriateness as two principles that guide the audit work, and really highlighted in the standard that sufficiency is a measure of persuasiveness. How persuaded are you? And therefore it relates not only to quantity of audit evidence, but quality of audit evidence. And we highlighted in the standard as a reminder that information may provide evidence that corroborates the assertions of management in the financial statements, or it may contradict the assertions of management in the financial statements. So we did issue, as I mentioned, our final standard. As you probably know, the IAASB is looking at this topic at the international level as well. We believe our final standard continues to maintain our commitment to convergence with international standards, but obviously the words are different now. Bob Dorer, who until last week was our chief auditor, as you may have heard, Bob has moved on now and is now the chief operating officer of RSM globally, really ran our audit evidence project, and also has been very active with the IAASB's audit evidence project and working group. So they are well aware of what we have done and very interested in it as they move forward on the topic. Move on to our estimates standard, which we've also issued in final form. This was intended to help with, of course, the wide variety of estimates that auditors need to deal with because of the prevalence of estimates in accounting frameworks these days. And we had CECL top of mind, to be perfectly honest, including when we talked about the effective date of our standard, which we ultimately decided would be calendar 2023 audits, which is aligned with the CECL effective date for audits of entities that are subject to our jurisdiction. This one is very well converged with the IAASB's estimate standard. We did, however, include some guidance from PCAOB standards as well, where we thought it would be helpful to understand that really the three standards on audit evidence that are all out and all fairly recent have common principles, even if the words are sometimes different. And we've been told in recent years that where we can use some language from PCAOB wording in our application material to indicate that the concepts are the same, that we have tried to do so. It is obviously intended to work in concert with other auditing standards. The approach we took with the estimate standard is to say, what is unique about estimates when it comes to doing an audit? So you do risk assessment in all audits, but when you're dealing with estimates, there may be some things that are unique to think about from a risk assessment standpoint. So we provided in the estimate standard supplemental guidance where we thought that would be helpful. We do specifically focus a lot in the estimate standard on the applicable financial reporting framework because obviously that's an important part of identifying and assessing the risks of material misstatements when it comes to estimates. How does the framework work, and is management following it properly? There's also focus in the standard on internal control and a recognition, given that our purview is the private company environment, that when it comes to estimates, internal controls are often less formal, less specifically laid out, more related to management review controls, and those may vary widely in their efficacy, and try to give guidance to the auditor that you need to understand what those controls are because that will help you understand the risk of material misstatement in this area. And in many cases, they may be less formal than they would be, and that may make it harder for you to obtain an understanding of them. And you need to be mindful of that as you plan and perform further audit procedures. And of course, we talk a lot in the standard about the risk of management bias and fraud risks, that when you combine perhaps a lack of or less formal internal controls with the potential for management bias, that is likely to increase the fraud risk, and that therefore auditors need to be mindful of that as they're designing their audit, and of course implementing our fraud risk audit standards as well. One thing that hasn't changed is the three primary methods of auditing estimates, which are, of course, to develop your own estimate as an auditor, to understand and evaluate management's process, which means understanding their methodology and the assumptions that they use and evaluating those assumptions, and reviewing subsequent events where they provide audit evidence that may be helpful in assessing the reasonableness of the estimate. And we try to make it clear in the standard that an auditor may use one, two, or all of those methodologies for a particular estimate. And there's discussion, as there was in the previous standard, of the extent to which disclosures address estimation uncertainty, including recognition of what the applicable financial reporting framework may require for disclosures that address estimation uncertainty. For example, I know some of your standards require disclosure of sensitivity analysis and the effect thereof. But of course, our auditors are also considering fair presentation, which may result in a determination that sometimes disclosures are necessary beyond the explicit disclosure requirements of the applicable framework. We did, as an offshoot of the estimates and really the evidence project as well, start a separate short-term project specifically on specialists and third-party pricing services. As the evidence and estimates projects progressed, those issues kept coming up, and we ultimately decided that having some additional guidance specific to particularly fair value of financial instruments and the use of specialists and third-party pricing services might be helpful. As you may know, the PCAOB has some guidance in its standards on these points. Our project is intended to better align with that guidance, although of course we want to remain principles-based. And our intent is to give a little more detailed guidance than is found in the IAASB standard, given the complexity of this area and the potential for material misstatement. I'll keep going. I am trying to keep an eye on the raised hands if there are any, so please interrupt me if any of you have questions or comments as I go along. I can get on a roll, but Ahava will slow me down if needed. Want to mention risk assessment as a project that we also recently got to the exposure draft phase on. I had the opportunity to serve as chair of that task force as we followed the IAASB's risk assessment project and then moved to update our own risk assessment standards. This, of course, is like, oh, Hal, did you have a comment or question?
Yeah, I was intrigued by your comment, Tracy, about making your own estimate and then looking at the process. Could you hum a few more bars about that? And I'm going to relate it back to CECL because we've spent a lot of time talking to banks. And as an investor, I used to make my own estimates as well. So it has some, I have some sympathy for the issues there. One of the things that the banks have been very consistent in telling us is that they expect their estimation processes to improve over time. What do you, or how does your standard, how does your approach adapt to a constantly changing process? Hopefully always an improving process. Would you expect auditors to keep the same method of calculating an estimate from period to period, year to year, or would you expect those to evolve over time as technology and data improve?
That's a great question, Hal. And, as I think about our estimate standard, we've tried to make it somewhat timeless, which I think reflects that current thinking on an appropriate estimate and the application of a particular financial reporting framework is what the auditor would be considering. And so, when I think about, for example, under FASB GAAP in the area of CECL, and I've been auditing banks my whole career, and so when you think back to FAS 5 and its generic guidance on losses and contingencies and that sort of thing, and then you bring in FAS 114 at some point to give a little more guidance on that when you get to sort of specific allowances, as we call them. And then you come forward to CECL with much more robust guidance on the accounting side. I think that's an indication that management's processes have to evolve. And as you folks drafted the standards, you weren't doing it in a vacuum, but you yourselves were reflecting, what are the expectations of users in the current environment? What is going on with banks' ability to get data and to manipulate that data and make use of that data? So I think expectations are ever increasing, and I think our standard is mindful of that, I would say.
So you would expect auditors' estimation processes to improve over time, because otherwise you're going to get wider and wider gaps, I would think, between your estimate and a bank's estimate. Or
a fair point. And I will say, with respect to CECL, and this is just my own thoughts, that certainly historically, my guess is most audit firms have primarily relied on the understand and evaluate management's estimate approach when it comes to the allowance for loan losses, rather than developing their own, because of the challenges associated with that, and perhaps not having access to as much data, certainly not having access to as much data as the banks would have. And then the subsequent events is difficult when you're talking a long time horizon for confirmation of charge-offs. So yeah, I that would be my expectation, is that the auditors and users' expectations of the robustness of management's process would likely be ever improving.
thank you.
So yeah, good thoughts and good dialogue there. Returning to the risk assessment project then quickly, this one was really responding primarily to audit quality concerns that we had heard from peer reviewers and from other inspections, both domestically and around the world, that there were auditors who were not doing an adequate risk assessment, either because they didn't understand the need to, or didn't understand the requirements of the standard. And as an important subset of that, not performing adequate work on internal control, particularly in circumstances in which the auditor did not intend to rely on the operating effectiveness of controls, which is certainly the case, often the case in audits of private companies, which again are our remit. So we have issued an exposure draft on risk assessment, as you probably know. It really is intended to enhance the auditor's focus on identifying and assessing risks in the context of the applicable financial reporting framework. So again, the framework is important to that. Obviously, when you think about CECL and other areas in which the framework is an important driver of the risks of material misstatements. We are converged with the IAASB. They have finalized their risk assessment standard, as you may know. But we did include additional guidance to reflect the U.S. environment. We talk a little bit about COSO because we know that COSO is a commonly used internal control framework in the U.S. Our standard is certainly framework neutral. The auditor is not required to consider COSO, and obviously the auditee is not required to use any internal control framework. And we know certainly in the governmental arena, the Green Book, I think it is, framework is used typically instead of COSO. And we also did include some PCAOB guidance where we thought that was helpful. There again, for the U.S. environment, PCAOB, for example, had some language on walkthroughs that we thought would be helpful, and we've included that in our exposure draft. So that's out for comment right now, and we'll see what folks think of it. I want to make sure I'm doing okay on time here. Looks like we are. I want to mention the quality management project. This one's in an earlier stage, really just ramping up. As you may know, the IAASB has finalized its quality, or voted to finalize its quality management standards. We have been monitoring and providing input to that project as we did for risk assessment, and we're really ramping up our project as well. Again, responding to audit quality concerns. One of the concerns that is near and dear to my heart is practitioners auditing entities without adequate understanding of their industry, including, of course, the application of the financial reporting framework in the context of the industry. And so what we're envisioning the quality management project to do, as the IAASB has done, is implement a risk-based approach, really analogous to the risk assessment process that is used in an audit, where a firm would evaluate the risks to audit quality, identify the risks, and then assess them and develop responses that are specific to those risks and to that firm. And so there again, if a firm is getting into a new industry where it's not familiar with the industry that its quality management process, we're using quality management instead of quality control, as it's a little broader, would include consideration of how do we acquire or obtain the knowledge necessary in order to audit in this industry. We believe it will be converged with the IAASB. As you may know, the PCAOB has also undertaken an update to its quality control standards and has indicated an intent to start with the IAASB standards. And I think all three of us recognize that having fundamentally different quality management standards for firms that may audit under all three sets of standards would be tremendously problematic and probably not a good use of resources. So while we may have differences, my guess is we'll have a pretty common basic framework as to how quality management is to be implemented by firms. I did want to briefly mention our attest standards. I don't think it was on the agenda, but we have had some activity there, and I know if it's of interest to you folks. We just finalized, as you may be aware, a standard that would permit the auditor to do what we call direct examinations under the attestation standards. Previously, auditors performing, and so attestation standards, of course, apply to things other than financial statements or elements of financial statements. So
Hey, Tracy, excuse me, you have a hand waiver, a violent hand waiver there.
Oh, I'm sorry. Dan, who was that? Here we go, Jeannie.
No, I was just given like a kind of a yay.
Oh, hooray for a test. Yes, Jeannie
yeah,
is
sorry.
our
Thank
task
you.
force chair. And thank you, Jeannie, for all your hard work on this. So as I say, previous to this standard, the auditor was required to get an assertion from management that it had measured and evaluated the subject matter. So whether you're talking about internal control, the SOC 1 circumstances, or greenhouse gas emissions, sustainability reporting, any of these other types of reporting that are becoming more prevalent, the first step under the attestation standards was always to get that management assertion that they had measured or evaluated, and then the auditor does their own measurement and evaluation in the audit. Now with the direct examination standard, the auditor, the practitioner is permitted to do its own measurement or evaluation and express an opinion without having obtained that management evaluation or measurement first. So we think that will broaden the universe of potential attestation engagements in the public interest. We get feedback that there is a demand for these services in situations in which the responsible party is not in a position, perhaps, to provide an assertion, has not done the measurement or evaluation, yet the users would like a measurement or evaluation by a CPA firm. And so that is out on the street. We will be issuing, it's not effective for a couple of years, although it can be adopted anytime. and we will be issuing non-authoritative guidance to help practitioners and everyone under all stakeholders better understand this service, and we'll see where it goes. We have also introduced more flexibility with regard to agreed upon procedures that have been around for a while. Rich, did you have a comment before I talk about that? I think you're on mute, Rich.
Sorry, Tracy, mine was more general, so let me let you finish this up and then I'll jump right in.
Okay, just a couple of points before to do that. The AUPs, the agreed upon procedures, we have revised that standard. They can now be general use reports, whereas previously they could not. And there is no need to get all of the users to agree to the procedures, which was a very restrictive requirement before. So instead, the new model is that the engaging party agrees to the appropriateness of the procedures for the purposes of the engagement. And then it's really on the engaging party to engage, not only with the practitioner, but with users as necessary to design an engagement that's appropriate. And the new standard explicitly includes guidance that the practitioner can participate in development of the procedures in addition to performing them. Many of us thought that was sort of implied before, but now we've explicitly stated that. And then the only other item I was going to mention on a test, Rich, is now that we have direct engagements out there, the question has come up about direct reviews. You can do reviews under attestation standards in addition to examinations. So we are going to take up that topic. I don't really know where we're going to go with it. We're just it's really nascent at this point, but if any of you have thoughts, or as we progress, if you have thoughts, we'd certainly be interested in them. So that's all I had on a test, Rich, and take your comment.
Sure, and Tracy, there's no doubt you folks have been busy, so I think all the practitioners greatly appreciate the help. One thing that FASB has been focused on for the last several years, and it's often captioned as part of a simplification initiative, but it's really looking for unnecessary complexity that actually drives costs and reduces benefits. And as you went through the listing of different standards that you folks were developing, it seemed many of them were designed to help practitioners audit in the current environment. I'm curious about the complexity and the cost-benefit analysis, though, that you folks go through as you develop your auditing standards. I'm sure some of the practitioners are voicing some concerns occasionally about the level of effort or the different efforts that they carry out, but how you identify those. So I'm kind of curious.
Yeah, that's a great point and a great question. It's also a good segue because the last item I was going to touch on is our strategy initiative, and an important element of our strategy is audits of less complex entities in particular, and auditors that are serving those auditees, and how do you deal with a standard as you folks deal with all the time? How do you draft a standard that is appropriately scalable for very large complex entities as well as less complex entities? The estimate standard is a good example. The risk assessment standard is a good example. What we have tried to do, and I'll talk about risk assessment as an example because it's one that I'm obviously intimately familiar with. We have tried to include in the standard, in the application material of the standard, some considerations for audits of less complex entities. And for example, when we talk about internal control, how the auditor can gain the necessary understanding of internal control in a circumstance in which the controls are less formal, as is often the case. Take an owner-managed entity that's a rather small and not complex entity, doesn't have complex operations. So we've tried to include some of that in the standard. We'll get comment letters, obviously, that will tell us how well we've done. We're always battling, as you do, the balance of how long is the standard going to be and still provide this type of guidance on how to make it appropriately scalable. The other advantage we have at the AICPA is our supplemental guidance. And we have, for example, an audit guide and always have on risk assessment, which gives us the opportunity to further flesh out examples and of less complex situations. You can take an example and lay it out, and then you can change a couple of the facts and talk about how things might be different. And so that's something that we recognize with these standards, that we need to provide supplemental guidance. The standard has to stand on itself. It has to contain all of the requirements and be able to be implemented by auditors without obtaining this supplemental guidance. But we also, want to recognize that, it isn't always just the standards that are necessary in order to meet a public interest. And so supplemental guidance can help as well. So that is a big part of our focus. I'll move on to our strategy, unless you had any follow-up on that point. And final item, to stay on track here, and we, as you may know, or some of you certainly know, we undertook an update to our strategic planning, if you will. We hadn't done at the ASB for a number of years. We put out a draft document. We did take some pages from the IAASB's recent strategy initiative. Put out a draft document with strategies and plans and actions at a high level, and asked for feedback, and we did get some feedback. We get some comment letters, and we also decided to engage in some targeted outreach and had meetings with a number of standard setters and regulators, including FASB. So thank you for any of you who participated. I know Russ led the FASB's participation in that meeting, but a number of you, I believe, were involved, as well as GASB and the GAO and the PCAOB and the SEC and a bunch of other folks. And that was invaluable because, of course, you get, as we do with these meetings, the opportunity to go back and forth and sort of further flesh out issues. And so the feedback we got from FASB and from the others definitely will be informing our process as we move to finalize. And outreach is going to be a big plank of our strategy going forward, to say who are the stakeholders and what are the ways in which we can effectively interact with them and have them involved in our standards. We recognize that certain types of stakeholders are much more likely to submit comment letters than others. For example, users and preparers in some cases may not be something that they have the time or take the time to do. So really looking at other ways that we can have periodic outreach. And we had a good discussion for any of you that were involved in the FASB outreach meeting about standing advisory groups versus sort of issue-specific groups that it's tailored more to the topic at hand. We'll see where we land on that, but we had some good advice on that. And particularly from my standpoint, doing more with users. We have had some outreach with users, and of course it depends on the standard. Users are probably more interested in certain standards than they are in others, but doing more to outreach with those. So that is a major plank of the standard. You folks gave us great advice on the need to balance international convergence with the needs of our jurisdiction. And I know that's something you wrestle with, and it's been, that dialogue was very helpful to us. And hopefully, as I went through our project list, you got some sense of how we have been trying to do that. Structuring projects, a little more structure to the project plan on the front end was something that was very helpful for you to give us guidance on. And also something as mundane as how to make meetings run more effectively. And it's my sense is you folks maybe do a better job of having lots of dialogue before the meeting so that the meeting time you can make the best use of it as possible, and issues have really been fleshed out and are ready for discussion at the public meetings. So we hope to take a page from your book in that regard too. So we're developing our final strategy and related actions, and we will be communicating all of this to the public in the not too distant future. I do want to get a new chief auditor on board before we finalize that. Hopefully you understand that. So I'll stop there and see if there are any other questions or comments. And if not, we can move on to the next item. Don't see any hands. So item 2 on our agenda, the discussion of auditability and potential cost savings of practical expedience. I have a sense Mr. Reisig may be involved in this conversation. So Rich, I don't know what's your pleasure. Do we want to have Rick kick us off, or did you have some?
Whatever way you and Rick would prefer, I think, at this point. So,
Rick, if you wouldn't mind, I know we have an instant proposal that is working its way through the process with the 409A issue, but obviously your participation in the PCC, maybe you have ideas that are specific to that, but then broader as well. And then from my standpoint, I'd really like to talk a little bit about how our respective staffs work together and how we can support some of these as well.
No, that sounds great, Tracy, and I very much appreciate being part of this meeting. It's great seeing all of you, old friends, whether I get to see your faces or your names. For the FASB folks, my first introduction to the FASB was as a part of the AITF this very meeting 4 years ago. So this is kind of a full circle thing for me, and I'm very appreciative of the FASB to allow me to talk about this particular issue. So I am here to talk about the exposure draft that's out there. That is a PCC driven initiative, if you will, and it does deal with valuation of share option awards for private companies. And so the first thing I want to just refresh everybody's memory on here is the difference between an accounting alternative and a practical expedient. This is a practical expedient that's being exposed. An accounting alternative is warranted when there's a different method for recognizing or measuring a transaction, whereas a practical expedient is warranted if there's just a more cost-effective way of achieving the same or similar accounting objective. So in essence, GAAP works, but is there a more cost-effective way of getting there? And therefore, this is a practical expedient that's being proposed in the exposure draft. So the exposure draft, for those of you who haven't seen it or read it or responded, I know there's several of you that are participating with ASB that your firms did send in response comment letters. Thank you for that. The exposure draft is determining the current price of an underlying share for equity classified share option awards. So just as the name implies, it's to address the valuation of private company share option awards. It was a PCC driven project. In fact, it's been a topic of discussion at the PCC before I became a member of the PCC even. So it seems to keep circling back, and it really hit home for us in probably in the last year and a half, to where we really started to focus more specifically on it and engage FASB members on the issue. So with share option awards, the discussion in the exposure draft really talks or makes reference to two different types of share option awards. You have your equity classified awards and liability classified awards. The exposure draft only focuses on equity classified awards. Now, there's several differences between the two, but one of the most significant differences is that with an equity classified award, it's measured really only once at the grant date. Now, there could be certain circumstances that might require another measurement, but by and large, it's measured only once. The fair value measured at the grant date. For liability classified awards, it's measured not only at the grant date, but then remeasured at each subsequent reporting date. And in fact, that's one of the questions in the exposure draft is, should the coverage under the exposure draft be broadened to include more than just equity classified awards? And there's some good, I think, responses in the letters that have been provided talking about expanding coverage, which obviously the PCC and FASB will discuss those responses. So again, the focus is only on equity classified awards. So now I think we all understand, I mean, the reason that the Private Company Council feels that this is an issue is in valuing the share option award, the determination of private company shares underlying the share option award is problematic. I mean, there's not a trade, it's not tradable, there's not a ready market, an established securities market for those shares. And for GAAP purposes, under topic 718, it drives us to an option pricing model like the Black-Scholes model, which many of you use in valuing those or auditing those option awards. And really there's 6 different inputs that go into that particular model. For example, one of the inputs being the fair value of the underlying share. And so the PCC recognized that, and through feedback from others, that that's probably the most complex input within the model. And so is that something that can be looked at for relief for private company preparers in establishing the fair value of the option award? So PCC pitched the idea to FASB. FASB very patiently for a long time listened to the PCC's pitch, and then basically decided, yeah, let's float this out there and let's draft an exposure draft and find out what constituents' thoughts are with the exposure draft. So FASB staff, along with FASB members and PCC members like myself, did participate in various outreach sessions with many different stakeholders, users, preparers, auditors, attorneys, valuation specialists, regarding the relevancy and the decision usefulness of the share option calculations. And the response back was, certainly there is decision usefulness within the calculation, within the concept of the share option award, thus warranting a practical expedient above all else, that it really is something that still is needed and necessary, but is there a more cost-effective way to come up to the same answer? So then our focus was, well, really what should be our ask in the exposure draft? You know, what should the practical expedient be? So the resulting ask is to allow a non-public company to use a valuation method in accordance with the presumption of reasonableness requirements of Section 409A of the Internal Revenue Code, which Tracy, you made reference to in the introduction. So just to frame up 409A, just very generally, it regulates the tax treatment of a non-qualified deferred comp. To us anyway, it appears a GAAP is silent in the definition of share option award as being deferred compensation. For tax purposes, a share option award is considered non-qualified deferred compensation, thus subject to Section 409A. And of course, the objective of Section 409A, just like topic 718, is the determination of fair value, fair market value. Now, a key part of 409A, of course, is the presumption of reasonableness. And so there's 3 acceptable valuation methods for fair value of a share. And first, of course, is a valuation determined by an independent appraisal within 12 months preceding the grant date. I will say there was some great responses in the comment letters in describing the linkage between 409A and 718 and some suggestions to improve the exposure draft dealing with that time period. Secondly, second method is a valuation based on a formula that, if used as part of a non-lapse restriction with respect to the share, would be considered fair market value. And then a valuation made reasonably and in good faith and evidenced by a written report that considers the relevant factors of illiquid stock. And that's really dealing with a startup. The issue here is, I think we're all aware, those of us who participate in the tax aspect of this in the 409A, is if there's a miscalculation, typically it would have to be a miscalculation for the most part in the valuation, because the idea is for the award not to be issued in the money, or in essence where the fair value is in excess of the strike price. If it is, then the employee is going to be subject to significant tax penalties. So that's really some strong incentive, we feel, to fairly value the share option. I mean, that we feel that the Internal Revenue Code requirements there are pretty significant for a company in arriving at the share option. So why would the practical expedient be an improvement? First, it would specifically allow an entity that receives a valuation in accordance with Section 409A for tax purposes to use that same valuation for Topic 718. I'll say there's quite a mention of it in the responses there too, as far as they feel that practice is already doing that. And we can certainly talk about that. Now, as an auditor, Tracy, you know, I understand much depends on the risk assessment. We've had quite a few discussions within the PCC meetings, along with the FASB board members too, as far as risk assessment and different auditors having different risk assessments, which then drives different procedures followed. But the PCC, by and large, believes that the audit documentation and verification procedures currently required in practice to substantiate a share option value, a fair value, could be decreased with the practical expedient. At least that's our hope. So maybe I'll stop right there and open it up to comment. So.
Great job, Rick. And I should mention as an aside, Rick was a key driver during his time on the ASB toward what ended up with our direct exams document. I always think of you as we move that through. So thank you for all your hard work there as well. Do I understand correctly, Rick, that FASB or the PCC has gotten feedback that there are auditors who are saying, at least in some cases, the 409A valuation will not suffice for GAAP purposes, and hence this conundrum?
You know, Tracy, first and foremost, I was going to applaud you guys on the direct engagement and the AUP thing. So thanks for mentioning that. So thanks for reminding me. Good job, you guys. And I know Mike Glenn's on the call here too. So good job, Mike. Yeah, you know, and Tracy was really in the outreach. I mean, it was, to me as an auditor, I always felt, well, why would it not work for both? And yet I will tell you, in the outreach that we had with some of the auditors and frankly some of the preparers were giving us feedback that their auditors were requiring them, even though they obtained a 409A valuation, requiring them to do a separate valuation. Now, I'll tell you, in the response letters that we received, I don't think there was a response letter from an auditor that said that they were requiring a separate valuation, unless of course they felt that the 409A valuation was deficient. The question that we were able to ask in the outreach discussions that really we weren't necessarily able to ask in the exposure draft to the auditor would be, how many times in an audit situation where you audited the valuation of a share option award did you ever change the valuation of the share option award because of your audit techniques? We were able to ask that question in the outreach discussions. We weren't able to ask that question in the exposure draft, which, of course, as you would understand, I'm interested in the answer. You know, so, but anyway, I hope that answers your question.
Yeah, it does. And I should mention, it's with great trepidation that I bring up tax topics because of my own lack of knowledge in this area. So take that for what it's worth. Sue, did you want to add something at this point?
Yeah, just in response to your question, we have heard on occasion, and it's come from some individual TIC members, that they do have some concern about the quality of the 409A valuations today, and that perhaps if it is used, you know, as a basis for this expedient, that, you know, there may be that process to develop the 409A valuation, or the folks that provide it may need to be more robust.
Interesting.
So, yeah.
Yeah,
The term drive-by was used. If you know what that means.
Windshield appraisal, I do. Jim wanted to weigh in here as well.
Yeah, thanks, Tracy. And one of the reasons we, you know, in the outreach, we really focused on that question is, of course, all share options awards really are subject to 409A, and therefore entities should already be doing some procedures to determine that the share option is not in the money and or following the appropriate tax consequences of that. So when we continue to hear that determination of fair value for accounting purposes is a really costly and expensive exercise, we were trying to figure out, well, since you're already required by existing tax law to do it, why is it that the accounting requirement is imposing any incremental cost, at least to the preparer? I can understand there's associated audit costs, but we were surprised, or at least some of us, to continue to hear that preparers are incurring incremental costs. And so we did hear that some are not relying on their tax valuation.
Christine?
Thanks, Tracy. My question is to you or to any of your colleagues that are with us today, and welcome. We're glad you're here. So my question is, could you just hum a few bars on the nature of the cost savings and the magnitude of the cost savings that you're anticipating from the practical expedient?
Was that for me or for Rick?
It's for you.
Okay.
Yeah, it's for you and
Yeah.
your members.
Yeah, and I'd certainly encourage any of my task force or ASB members to chime in as well. I am not sure, to be honest, and I don't know if TIC's comment letter is in yet. I know they've been working on it, and they were nice enough to include a brief sentence or two about the ASB's concern. My concern about the exposure draft is actually not so much the words of the proposed standard, but the potential that preparers and auditors may misunderstand the proposed standard. It has been my understanding, and again, not a tax expert by a long stretch, but it's been my understanding that even with the appraisal option under 409A, that there is some standard for reasonableness of assumptions and methodology. That if I learned a new term during the course of this 409A shop, which I had not heard before, but apparently there are folks that do a lot of these. So it's been my understanding, and somebody can correct me if that's wrong, nobody has yet, that that there is some standard of reasonableness that needs to go into the appraisal itself. And so therefore, it seems to me that the preparer is responsible, management is responsible for assessing the reasonableness of the methodology and the assumptions, and certainly that the auditor would also have that responsibility. And so my concern has been that people might misunderstand the practical expedient and think they don't need to do that. Preparers thinking they don't need to understand and evaluate anything about the appraisal, and then either auditors thinking they don't either, or preparers thinking that auditors don't, and thereby creating a conflict.
Yeah, I'm on a
audit
red
process.
call. I just stepped out.
That I think is going to be in TIC's comment letter if it isn't in already. At a minimum, my hope is that it sounds like you may be getting that from others as well, that you take a look to make sure that the guidance is clear on management's responsibilities with regard to that. And the other point I would make in this regard, and it kind of gets to the broader agenda topic, is it struck me in the last several months how well our staffs worked together on some of the COVID guidance that went out. It was non-authoritative, but it was quick, and it was something that I know your staff was involved in, and it seemed to me to be a very helpful process. And that's what I heard from my fellow auditors as well. It was really appreciated, and this kind of strikes me as an area that perhaps some staff guidance may be appropriate as well, whether that's AICPA staff guidance with FASB staff involvement, or how we do that to say, you know, here's what 409A requires, and here's what the accounting standards say, and how these responsibilities for making assumptions, for example, you know, really do intersect. Hal?
So Tracy,
I think
just a follow-up question then.
Oh,
So
sure,
is
Christine.
your sense that if the practical expedient is made sufficiently clear on management's responsibilities and the auditor's responsibilities, that there will be still a significant a significant cost savings associated with this?
Only if, as Rick mentioned, there may be some auditors who feel that a separate valuation is necessary. My firm has not taken that position, and sounds like some of the outreach you're getting is people have not. So I'm, to be honest, a little skeptical, Christine, about the potential for savings. But if in fact there are auditors who feel that a separate one is needed, then this practical expedient would at least take away that impression, and then they can focus on the appraisal that was done and decide if the you know, the approach was reasonable.
Right.
Hal, sorry.
No, I'm
Is that
glad Christine
an
felt.
area where you think, sorry, one last question. Is that, oh, sorry. I just wondered if that's an area where additional education might be helpful. And then I'll.
Yeah, that's sort of where I was headed with my thought of, you know, having our staffs work together to see, is there other guidance for auditors or for management, or both, about, you know, what, and certainly if this is finalized, but even if it isn't, if you decide not to, for whatever reason, you know, some guidance on, you know, what are these 409A appraisals? How do they work? How can they be used as audit evidence, and under what circumstances? Okay, Hal, I promise to let you talk now.
I'm waiting. I'm going to give Christine one more shot. Christine? No. I just want to follow up on a comment I thought I heard earlier, and I think it was Rick who said there were some 409A evaluations that were deficient. I think was the word that was used. Do you have a sense of the level of deficiency? You know, is it half, a quarter, 10%? Some sense there. And is that really the source of higher cost if there are in fact a substantive number of deficient 409A, you know, evaluations? That's where by putting greater spotlight on this, you actually are increasing the cost, at least initially, to flush out the more deficient 409 evaluations.
I think that one was for you, Rick.
Is that for me, Hal?
I'll let it to anyone in the group, including yourself, Rick.
Okay, my response to that, I know some of the responses in the comment letters address that too, Hal, and just to be clear, that's the wording that they had in the response letters was where they have done an additional valuation is because they felt the 409A was deficient. They don't go into detail on how they felt that the 409A valuation was deficient and what drove it. I know that there's some comment. I think there could be that where it might raise the bar on the 409A. I know that there was some comments in the verbal outreach where some of the evaluators said, well, you know, when it's for an audit situation, it's more robust as far as the 409A versus if it's just not in a financial statement audit situation, which I can tell you from an auditor perspective, shocks the heck out of me. Yeah, I'd be more afraid of the IRS, I think, but that's the response that we got. And so I think it could raise the bar on the 409A and potentially raise the cost of the 409A. But again, if it's a better valuation, I'm not so sure if that's not a bad result if we can use the 409A as the basis for the valuation.
So Rick, the bottom line here is that this standard would raise the awareness that a 409A evaluation can do dual purpose. And if you accept that it can do dual purpose, you've cleared any roadblocks to that, then as long as it's done well, you have no issue. You get value. So Tracy's concerns about cost are really where it's not done well, or and some of the feedback that we've already received. It's where it's not done well. And is that a cost that you all think that we should be evaluating or considering? My general belief is we shouldn't, if something's not done well or right, we should not consider that cost in the overall evaluation.
Fair point. Sue, do you want to weigh in on this one?
Well, I was sort of mulling over in my head, you know, the expedient and what it was intended to achieve. And I wonder if in some instances it becomes a shifting, if you will, right? Because I don't know that the expedient was necessarily to achieve that we eliminate one of the evaluations. It was to be used in lieu of, but some of the costs that we've heard about over the years of discussing this are around the auditing of the assumptions. And I think, just to be clear in my own mind, that doesn't really go away. So you have to audit the assumptions if you use a separate third-party valuation, or if we allow this expedient and you use a 409A valuation, you still have to audit those assumptions that are the basis for preparing that valuation. And so I think that, if the cost savings that we're thinking about is in between those two, that's one thing. If we're just talking about eliminating evaluation, well, that's a different cost. But it's clear in your mind that there's no difference in terms of auditing and the assumptions that factor into those valuations.
Exactly. And I guess one, the situations that arise where the auditor says that no valuation you had done was no good, we need to get another one for the audit. I would hope to heck that with perhaps some more visibility on this issue, there's more dialogue earlier in the financial reporting process. As you all know, it's fairly common when there are, for example, actuarial valuations done, that there is dialogue on the front end about what sources of assumptions should be for discount rates, for example, and things like that. So, I would hope that that you want to get at the end of the day, probably to one valuation that meets both GAAP and tax purposes, and has a methodology and assumptions that are reasonable in the circumstances. And that's the holy grail, and auditors should be able to sign off on it. So, Rich, I know we're starting to bleed into our next agenda item. I guess my final comment to reiterate would be we are eager to continue to explore opportunities to work together to provide guidance beyond standards to the marketplace in situations where we become aware of this friction, and this might be one of them.
Okay.
So go ahead, Rich.
Great, Tracy. Well, thank you. And that was a very helpful discussion for our board members. As you can see by the level of engagement there, it's an issue we're looking at, and I appreciate the input that you've shared, and look forward to working with you as we continue through on this. I think the next topic on our agenda is our post-implementation review. We are a few minutes behind, so I'll run through the overall process, and then we'll talk about the 3 standards that we have that are currently undergoing post-implementation review. I may go through this at a high level and fairly quickly, but rest assured, if you go to the FASB.org website, right on the front page, there's a link to our post-implementation review page that gives a much more in-depth summary for those of you who'd like to see that. I'd also direct you to Accounting Today. You'll see a great interview with Hilary Salo, our technical director, who does a better job than I'm going to be about to do on the overview of the post-implementation review process. So I'd encourage you to look at that also. So first question usually is, what is the post-implementation review process? So effectively, it's an important part of our control mechanism, our quality control mechanism on standards. And it's a process which begins immediately after the standard is issued. And what we look to do in that post-implementation review process is to perform an evaluation of whether a standard is achieving its objective. And by providing financial statement users with relevant information in ways that justify the cost of providing it. So effectively looking back at our cost benefit analysis and making sure the benefits of the standard are there and the costs are there. From my perspective, there's another important byproduct though, because when we do these major standards, very often we can learn lessons for future standard setting in other areas. So for example, if we were to find out that transition complexity or interaction, for example, with business combinations was a frequent area that we had to take a look at in post-implementation review, answer questions, or possibly modify standards, I think that would inform us as we look to set standards in the future. So what's different? Maybe why are you hearing a little more about post-implementation review now than you did in the past? Part of the reason you're hearing a little more about it is because we have 3 major standards that were just issued and in a relatively short period of time. So RevRec, CECL, and Liaison. And those are the 3 standards subject to our full post-implementation review process. The other reason that you're hearing a bit about it is because we've effectively transferred it. Previously, the post-implementation review process was done by our FAF employees. And there was a report issued effectively to the FASB as well as the general public. What we took a look at, and the FAF trustees agreed with us on this, was actually it made more sense to transfer that process into the FASB, because as part of our normal process, we are trying to continuously improve our standards. And the post-implementation review is a key part of continuously improving our standards. It's still under the oversight of the FAF trustees. It's still a public report to the FAF trustees, and it's still subject to their oversight. But it does enable us to kind of get some efficiency in the process, because as we're reaching out with stakeholders on our new standards, we're able to get input as part of both the post-implementation review process, as well as any standards that are action that we would like to take. So let's see. One of the other reasons I think the post-implementation review probably has some increased focus right now is because these standards were all done with phased effective dates. If you think about them, there was an adoption date for the public entities, the PBEs, and some public entities, but the non-PBEs followed it a few years later. And one of the reasons that the board did that was because, one, it was so that the second wave of adopters could learn from the first. But I think one of the byproducts of that also is that the board itself could learn from the first wave of adopters and understand if there's anything that we need to address for the second wave of adopters, recognizing that very often those non-PBEs may have a different cost-benefit equation than the PBEs. And we need to understand that and understand if there's any changes that we need to make. So the PIR process, and a few of my fellow board members are going to walk you through a few of the standards. I'll walk you through CECL. It's really in 3 phases. The first is the post-issuance date phase. It's where we look at the implementation and monitoring the implementation of the standards. The second is a post-effective date evaluation of cost benefits, which you'll hear about as we talk about some of the standards. We're actually entering that phase. And the third is a reporting phase to our trustees and the public. So how long could a post-implementation review process take? Could take 3 years, could take 5 years. But the key part about, and one of the key benefits of bringing this back to the FASB is we don't wait 3 to 5 years to communicate and take action. We will be communicating and taking action if needed throughout that process. And I think that's key, and I think that gives our stakeholders great comfort that we're listening, we're doing that constant outreach, and we're prepared to react. So let me pause there. Is there any general questions on PIR? Because we're going to jump right into CECL, and I'll give you some illustrations of some of the activities that we've already carried out. And then I think I'm going to turn it over to, let's see, who else do we have here? Gary Buser is going to cover revenue recognition, and then Sue Cosper leasing. So just throw your hands up at any point in time if you have a question. All right, so from the CECL PIR activities, some of the activities we've completed to date have included, we did form a transition resource group that was part of the implementation process to understand implementation issues and make changes either prior to implementation or during the implementation of those standards. And I think that was a very effective group for all of our stakeholders to participate and share their perspectives. To give you some idea of the volume of activity we've had, we've responded to over 70 technical inquiries on the application of CECL. We've conducted outreach with over 150 stakeholder groups. So that was both, this is all post-issuance, and it's a significant outreach efforts. We've issued 6 updates related to topic 326. So this is kind of examples of our real-time action to address any issues that are coming up and being raised. 2 staff Q&As to help with implementation, meaning we didn't need to change the standard, but we could explain how the standard could be applied and improve its efficiency and effectiveness. We've conducted multiple education workshops and roundtables. We started those in person. Unfortunately, we've had to migrate those to Zoom and other mediums, much like everything else, but those are continuing. And we're also monitoring 10Q filings and earnings calls, and that's been very important. What we've also started doing is the post-adoption interaction with stakeholders in understanding from preparers. Tell us what your adoption was like. What were the costs that you incurred? Were they one-time costs? Or are they recurring costs? What are some of the challenges you're experiencing? What are you seeing amongst your peers versus you? We're also doing the same thing with users, be they at buy side or sell side, and understanding what information are you getting? Is it the information you expected? What challenges are you having? Is there information that you see on one registrant that you would have expected to see on other registrants, so we can understand what that is? What are your challenges with comparability between entities? So those discussions are ongoing. I'll tell you, they've been very helpful to me. New in my role, I'm very impressed with the outreach that the FASB staff does. And I'm very impressed with our stakeholders' willingness to meet with us. By the way, we are also meeting with practitioners. So there's the auditors. We are also meeting with and getting feedback as to auditability, as well as what they're seeing in their clients. So you will see periodic updates on our website on the PIR as we report out on these differing activities. The other thing that we have scheduled is we're scheduling for, I believe it's the end of the year, beginning of next year, a public roundtable on CECL, which will bring all stakeholders together from all different perspectives to discuss what issues they've seen, what have been the benefits, what have been the costs associated with the standard. And I don't know if any of you've watched any of our other roundtables. I think Gary will talk about one, and as will Sue. I find those very informative when you bring the different stakeholders together in the same room to talk about issues, because very often you'll hear when someone starts describing an issue, very often someone across the table may have a potential solution, even without changing the standard, or possibly they may agree on there's some tweaks we need to make to a standard to improve its operation. So that's where we are. CECL process will be continuing. You'll still hear a lot about it, particularly, and I know that those of you who work with companies that are pending adoption, and you talked about your new estimation standard. So 2023, it does sneak up on you pretty quickly. So we are moving quickly with this process to make sure that we have information to make any decisions we need to make prior to that adoption date. So with that, let me pause. Any questions?
Rich, I guess just one that occurs to me that relates to all 3 of these.
Mm-hmm.
FASB has been very receptive to input on these standards and has issued, I think, for each one of these 3, a number of subsequent ASUs amending or clarifying the original standard. As helpful as those are, I couldn't help but think it must be frustrating for you folks to get that feedback after the standard is out. That wasn't there, would have been good to know more about this before. And I understand, people's lives just are driven by the exigencies of the day. And sometimes until you really implement a standard because you have to, because it's effective, you don't fully run into all the issues. But I'm just curious as to, from your perspective, and the reason I'm asking is, we have some pretty fundamental standards that we're putting out, and what will we be dealing with that issue? And so from your standpoint, is that simply sort of a fact of life with these very fundamental complex standards, or are there lessons in terms of how you do outreach that could help with that?
So I personally don't find it frustrating at all. In fact, I appreciate that our stakeholders come to us to help us improve practice. And that could be reducing costs, or it could be improving the operation of the standard. Also, as a over 30-year practitioner, and I spent part of my time writing comment letters to the FASB, and I will tell you, I learned things after an exposure draft and after writing a comment letter to the FASB as companies started applying it. And I think that unfortunately that happens. It's very hard to anticipate every issue and every industry and every type of transaction that's out there. That being said, and while I speak for myself, I think my fellow board members feel the same way on this one. They can nod if they don't. Is we all believe standard setting is an effort in continuous improvement. And so by its nature, we're going to get input on things we've done. And I think we're very receptive to admit, hey, we might have spent a lot of time on this, but we're not saying it's perfect. So if there's something that we can do that can improve it, I think we're very willing to consider it. One stat I often throw out there is when I went back to the old leasing standard, so FAS 13, I think the EITF by itself amended it over 30 times. And that doesn't count all the other standards. Now, that's not a number we're striving for. We're striving for a much lower number, but I will point out that that is part of the standard setting process.
Rich, it looks like Jim and Sue might also want to weigh in. Jim?
Go ahead, Jim.
Yeah, I apologize for the background noise. I got some work going on here, but many of the same comments as Rich. I think particularly given the size of the standards, not frustrating at all that when people actually go to implement that there were unintended consequences or transactions that they didn't actually realize were either in the scope or not in the scope. Those types of things are not surprising, and I would encourage people to highlight them for us. I also think that's one of the benefits of the PIR, to take stock later. Are there things that we should have or could do differently in the future? Some will just continue to always be the case that we just learn more, but others might be sort of learning for future standard setting as well.
And just to be additive, when I think about, the original premise behind some of the transition resource groups, right, which were part of the post-issuance phase, or, the idea there was to have a voice for preparers and others in the industries that were affected, to be able to say, what was your intent, FASB, instead of having somebody else tell them what our intent was. And so to the extent that we can provide some clarity to make sure that what we intended is actually how it's applied, to me is a great thing.
But Tracy, I would encourage that ongoing feedback from your group and from others. We appreciate it. And at the end of the day, we can only improve with participation from our stakeholders. And that's key to it. And we're very receptive to it. With that, if there's no more questions, I think I'm going to turn it over to Gary, and Gary's going to give a quick overview of some of our PIR activities in RevRec.
Good morning, everyone. Just to follow with Rich's comment, The PIR process can many years after the issuance of an ASU. The RevRec, as you was issued back in 2014, and here we are in 2020. So what have we done in 2020? We've issued one ASU and one proposed ASU related to non-public business entities and revenue recognition. The first was issued ASU 2020-05. Effective dates for certain entities was issued in June. Straightforward, defers the effective dates for both 606 RevRec and 842 leases. Why do we do this? In our outreach on the franchisor revenue recognition project, we heard back from many preparers that they were still having difficulties given the COVID-19 pandemic implementing revenue recognition. The deferral gives an additional year to entities that are non-public business entities, and two, that as of June 3rd, have not issued their financial statements or made financial statements available for issuance to adopt Topic 606 for annual reporting periods beginning after December 15, 2019, and for interim reporting periods within the annual reporting periods beginning after December 15, 2020. So that's relatively straightforward. The second area was the proposed ASU that was issued on September 21st. Franchisors revenue from contracts with customers, subtopic 952-606. The amendments in this ASU would apply to entities that are not public business entities that are within the scope of 952 franchisors. The board added this project to the agenda and issued an exposure draft to address the issues raised by stakeholders who expressed concerns about, first, the level of effort, i.e. cost and complexity, required to account for initial franchise fees by private company franchisors, and second, the accounting outcome of the sum or all of the initial franchise fees over the franchise license term. If you remember, pre-606, the initial franchise fees were generally recognized upfront. The amendments in this ASU would introduce a new practical expedient that would allow entities to account for pre-opening services, generally referred to as initial franchise fees, as a single performance obligation if the services are A, consistent with those included in a predefined list within the guidance, and B, as long as it is probable that the continuing fees in this agreement would be sufficient to cover the franchisor's continuing cost plus a reasonable profit. Some examples of predefined services would include site selection, opening, preparing facilities, and the training of franchisees' personnel. The net reporting impact from this proposal is that under Topic 952-606, franchisors who are not PBEs would most likely recognize the initial franchise fees up front, similar to pre-606 recognition. In contrast, public companies are generally recognizing IFFs over the license term under 606. In the ASU, we have included 10 questions for respondents, and we welcome your comments, which are due by November 5th. Are there any questions?
Gary, I don't know if my question is for you or for Rich, and I want to preface it with, Rich, I know it's almost 11:30, and I think most of what we have left is FASB project related, so I will defer to you to tell us what we talk about and cut off where we do. And maybe you want to start by cutting off this question, but I'll ask it anyway. I know the AICPA, through the Revenue Recognition Audit and Accounting Guide, has tried to sort of bridge the principles-based standard where FASB has tried to be sort of industry neutral to the extent possible with questions that come up, on the front line in particular industries. And so I'm curious, I know you're collecting feedback on this proposed ASU for franchisors, but curious as to whether you've formed any preliminary thoughts yet about how you protect against that risk given this issue?
Yeah, no, I think that's a fair concern. I think it's one that we're focused on. This particular issue, I think the staff had done long efforts on education. We'd spent a lot of time with this industry, and I think, at least from my perspective, what we were seeing is the way the standard was being adopted was not consistent with the standard. And those of us who were supportive of this exposure draft felt it was time to make a choice on the quality of adoption of this standard. And in this particular area, that was why we took the action we did. There are concerns, though, about, when you drill into a specific industry or not, and many of the dissenting board members had those concerns about industry-specific guidance. That being said, I think you can see in the exposure draft some of the rationale and the basis for the conclusion, as well as the dissenting views. That's why we're eager to hear kind of where stakeholders' perspective are on this standard.
Since there are no questions, I think I can turn it over to Sue.
Sure. So I'll just speak a little bit about leases. And what I find interesting about all of these post-implementation review topics is that we're certainly at different, I'll call it, stages of the life cycle of post-implementation review. And I feel like I'm the one in the middle with leases, with credit losses and revenue, maybe on the bookends. But in any event, Gary mentioned the change that we had to the effective date on leases. And when I think about it in terms of the post-implementation review process, one of the things it really afforded us to do is spend a little more time on the topic and really gauging from the public company adopters, where were your areas of costs and complexity? Where were your quote unquote pain points, if you will, so that we could really evaluate those areas and see if, are there things that we could simplify? Are there things that perhaps need more clarity, either through standard setting or through education or whatnot? And, because of the COVID-19 pandemic, of course, we had planned to have a roundtable last early spring. And so that kept getting deferred until we had it a couple of weeks ago. And in that roundtable, we focused on a limited amount of topics, but at the same time, I think that they're topics that all could be very impactful to the private company adoption. Things like the incremental borrowing rate. And, is that difficult to calculate, in our simplifications that could be made there? The lease modification model, embedded leases, for example, even though the standard itself didn't really change that, the outcome, is certainly something that has more emphasis under 842 than it did under 840. And then lease allocation of payments. And so I think the roundtables, we got very good information. We had certainly a cross-section of stakeholders from the public and the private community and users. I think that there were some good suggestions put forth, and I'll use the incremental borrowing rate as an example. Certainly that's an area where we did allow an expedient for private companies in the core standard that allowed for a risk-free rate. And in some instances, like one of the participants suggested, well, gee, it was an all or none. Could we maybe allow some option for underlying asset group or something like that? Because in effect, the risk-free rate has the propensity to increase the liability. So I think we got a lot of good feedback from the roundtable discussion that, the board will evaluate as we move forward. But I think that, if you sort of think about where we are in the process for the post-implementation review on leases, we're getting good information. We're going to evaluate that. We're going to decide whether or if there are additional changes that should be made to the standard as a result. We're certainly continuing to do outreach on costs with our advisory committees and councils. We recently discussed it with the private company counsel. We just started to do outreach on benefits in terms of looking to the investors of public companies to understand, did you use this information? Was it the right information? Is there other information that we should be providing? So we're in that phase of having those initial discussions with investors. And again, it's all in an effort to understand whether there's tweaks that could be made. And certainly I would be remiss, you pointed out, Tracy, that we did make a number of amendments in the post-issuance period. We also have one in the hopper coming up that will be issued shortly on 3 different topics that will allow for some additional reduction in complexity, make things a little bit easier. So I'll stop there because I know we're sort of stretched for time. If there's any questions.
Okay, thanks, Sue. Yeah, we're about 15 minutes behind schedule. We can definitely abbreviate our closing comments, but so with that, maybe we can jump right into the next section, which I think is Marcia. It's a joint discussion on going concern.
Yes, I just wanted to talk quickly about the going concern standard. So this is a standard that was issued in 2014, and the current economic turmoil is really the first time that since the standard was issued, that we've seen this kind of an economic situation, especially so broad-based. This may be resulting in a time when this standard is getting a little bit more attention, and we certainly are paying a lot of attention and monitoring this and stand ready to provide input on how to apply the standard. A couple quick comments. First of all, as it relates to the standard, this does require management to assess its ability to continue as a going concern. Management must determine whether there is substantial doubt about the entity's ability to meet its obligations. And if there is doubt, there are disclosures required, such as the nature, the evaluation, and whether there are plans to alleviate the doubt. If those plans are not sufficient, then there are additional disclosures that are required. Now, one reminder about the standard is that the period of assessment goes to or through 1 year from the date that the financial statements are actually issued. So management needs to understand conditions that are known or knowable and how they may affect that period of time. So when we've had some of our advisory council meetings since the pandemic in the era of what we call this COVID era, at our not-for-profit advisory committee meeting, this area of going concern came up, and some committee members observed that maybe there should be more disclosures than what they are seeing as it relates to subsequent events or some of the assessments that management may be doing. However, they did observe that they believe the existing guidance is sufficient in these areas. It's a matter of how the pandemic is going to affect what the disclosures and what management assessment should be. At our FASB meeting, this was discussed in both June and September, and some council members again talked about the disclosures that they are finding helpful, specifically as it relates to liquidity, debt covenants, defaults. This could serve as some indicators for investors or users of the financial statements, and it could identify areas to get in front of what could become a going concern issue in the future. So those are important disclosures. And as it relates to the mechanics of applying the standard, we have received some questions about how to consider what management believes are temporary declines in the value of some of the non-financial assets when performing their assessment of the going concern assessment. So again, given the current environment, as the quarters continue, as the COVID-19 pandemic continues to affect businesses and plans become more clear, we continue to pay attention and monitor the disclosures and how the standard is working. And we're interested in your input as you deal with applying the standard in your examples with your clients as well. And before I close, I do want to express appreciation to Bob Dorr and Ken, and I hope I have this right, Tisiak. I hope I said that correctly, Ken. You published an article in April, which was very timely, and that was in the Journal of Accountancy about going concern tips for auditors, and we appreciate that education. Thank you.
All right, no questions. I think next, Jim.
Yeah, so I think the next topic, particularly in the current environment that we wanted to talk about, was some of the feedback that we've been hearing from advisory groups and liaison meetings on impairments of non-financial assets. And I think many of the discussions are really just a reminder of the various models that apply to non-financial assets. It's, for certain people practicing accounting, maybe the first broad-based downturn they've experienced in their career, and certainly maybe the first in a decade plus. And so an ask from us that continues to come up is for educational materials. Our staff is working on that, illustrating the different models that apply to PP&E or fixed assets, how that differs from goodwill, the models that apply for other intangibles, questions about ordering, what order do I do impairment on? So really just a request there for educational materials. Another question that comes up with the relative degree of frequency is, how do I think about impairment indicators? And so as we've talked to the various liaison groups, certainly in some fact patterns, impairment indicators might express themselves on an individual day. You think about, a hurricane or a tsunami that has a broad-based impact on an individual day. Indicators may be easier to pinpoint to exactly when it occurred. Many other impairment indicators or impairment events occur over a period of time. That is, things start to deteriorate, things get better, things get worse. And so questions of how do you think about impairment indicators in the context of a global pandemic? Personal view, not accounting advice. I think the pandemic tends to be more of the latter. That is, there isn't an individual day you could pinpoint to say, this is the day that I have an indicator. And so maybe thinking about broadly the situation that you find yourself in as an entity. So you have, bad news, you have some news that's there to help to assist with the pandemic in the form of the CARES Act. Do I think about that, in a combined basis? And particularly challenging for different types of companies. Some companies have March 31st financial statement deadlines in a quarter. Obviously, you don't have the benefit of further events. Others, private companies don't in all cases have those quarterly financial reporting dates. So how do I think about impairment indicators in those two contexts? And then I say maybe the third is really, and this came up at our last PCC meeting and our meeting with TIC, is how do I think about impairment and then potentially subsequent recovery all within an individual financial reporting period? Again, it expresses itself probably more frequently in private companies. Even if you think about the situation broadly, certainly there will be some companies who, in March or April or May would have found themselves having an impairment, and maybe things get better for that entity by year end. And how do I think about those reversals? Given the gap requirement to take an impairment when you do have an indication of impairment. And so I would say that's really more a request for FASB. Do you want to engage in some form of standard setting? And I would say on that, I think we're taking that advice, in-house and determining what if any next steps we should take. So just a quick discussion of impairment. Happy to take any questions.
Jim, thank you. And I greatly appreciate the opportunity to observe the FASAC meeting last week or week before. I forget that this was a topic of discussion for sure. And from an auditing standpoint, one of the things I worry about, and I worry a little less on the sort of property, plant, and equipment side, because that is, you've got that two-step process, and you can very likely convince yourself that there's an undiscounted cash flow scenario with the expected government relief or whatever, that you never end up getting to an impairment charge. But of course, goodwill and other indefinite lived assets, it's more of a, if you have an impairment, it's fair value, period, kind of thing. I'm curious, and I worry about auditors and preparers, for that matter, in the private sector, come January, February, having to put their minds back to some date. As you point out, it isn't, and Rich, it's not necessarily a March 13th, but it's some period that there were some indicators. And certainly if you tried to sell a restaurant in early April, you may well find that its fair value was lower. And if there was goodwill related to it, that, you know, its fair value was lower at that date than its book value. As you look at this issue, and I know you have the Goodwill Project on your docket, has there been any discussion about possibly the IASB sort of allowance and recovery model that might help alleviate some of this?
So we haven't decided next steps. Certainly we've talked internally about various approaches. Again, not to the point where we're actively debating standard setting solutions, just thinking if we were to do something, how could someone address some of the issues? Obviously the ISB model, where subsequent recoveries are recorded, or at least for certain types of assets, is one approach. Another might be that to allow someone to do an impairment test as of the date of financial reporting. So if you hadn't done interim reporting, you could do the test at year end. Each of those comes with their own, of course, challenges. If you say, well, you could do financial reporting for impairment as of the balance sheet date, not the indicator date, you got to figure out, well, do I flag something at the indicator date? You know, does quarterly financials sort of disrupt that? Is that your next financial reporting date? So you're locked in. You kind of get different permanent answers than public companies. And if you're a private company, you know, that probably helps some, probably doesn't help others. If you subsequently go public, do you then have to go back and unwind that to do the public company accounting? Doesn't mean, again, that we aren't taking it seriously. And I think, you know, probably some follow-up, but I think as we think about it, we want to make sure that we've got a full view of what the issues that will come up in any standard setting alternative.
And I'm sure a key question being what users do with impairment charges. And I know we've talked about that at these meetings in the past.
Great. Thanks, Jim. Thanks, Tracy. I think next up is Hillary.
Sure. Thanks, Rich. So just wanted to give a quick highlight with regards to what the staff's been doing to really focus on stakeholder support. And I think we've mentioned this a few times today, but really we've gotten to work, I think, since COVID really happened, on Q&As, on educational materials, and really helping stakeholders through our technical inquiry process. So just quickly with regards to our Q&As, we've issued 2 Q&As related to hedging and leasing to really help deal with what are the impacts that companies are, you know, having with regards to COVID and these issues. So for example, for hedging, we've issued a Q&A that clarifies how a postponement of a forecasted transaction related to the effects of COVID-19 should be considered in cash flow hedge accounting, effectively clarifying that if you have a delay in the timing of a forecasted transaction, that doesn't mean that you necessarily need to reclassify all amounts out of AOCI into earnings immediately, assuming that your forecasted transaction still remains probable of occurring. In addition, we clarified that if an entity misses a forecasted transaction, that's not necessarily considered a strike when determining whether or not an entity has a pattern of missing forecasted transactions and therefore wouldn't necessarily be able to apply cash flow hedge accounting for future transactions. Now, with regards to leasing, we're really focused on stakeholder questions on the application of the lease accounting guidance for lease concessions related to the effects of COVID-19. So we did clarify that for concessions related to the effects of COVID-19, an entity will not have to analyze each contract to determine whether it needs to apply the lease modification guidance. really as long as the concessions don't result in a substantial increase in the rights of the lessor or the obligations of the lessee. And we also clarified through that Q&A that there are multiple acceptable ways to account for concessions where you have a deferral of payments, where a deferral of payments is provided, but there really aren't any substantive changes to the consideration in the original contract. So those Q&As are out there on our website currently. With regards to other educational materials, Jim had mentioned the fact that we are in process of putting together educational materials on the impairment of goodwill and non-financial assets, but we're also putting together educational materials on the borrower's accounting for debt modifications. And that really includes kind of a plain English overview of the accounting for a TDR versus modification of debt, which I think will be really helpful for a lot of entities. Also, we've been spending a lot of time on technical inquiries. So you can guess and I know Tracy had mentioned before, working with the AICPA staff related to certain technical inquiries, but we're working through the gamut from leases to interest income, fair value, hedging, accounting for PPP loans. So we continue to get those questions in the door, continue to collaborate with the AICPA staff, the SEC staff, banking regulators, and other stakeholders in trying to help answer those questions as they come up as a priority item for our stakeholders. The last thing just want to refer to is reference rate reform and the fact that we are continuing to monitor some of the changes in the marketplace related to reference rate reform. So you're probably aware that we issued an ASU in March that provided guidance on how to kind of ease the process away from migrating from LIBOR to new reference rates. And those can be in debt instruments, they can be in derivative instruments, or in lease contracts. But we're also seeing certain changes in the marketplace for items that weren't necessarily within the scope of our guidance on reference rate reform in 848. And seeing some of the changes in the marketplace, we actually will be bringing an issue to the board this week to talk about one of those emerging issues and to consider if the board would like to add a project to the agenda to discuss that particular issue. So again, just highlighting the fact that we are monitoring what's going on from a marketplace perspective and trying to be as responsive as possible, whether it's through Q&As, technical inquiries, or through standard setting. With that, any questions?
I don't see any, Hillary, so thank you. And I appreciate, by the way, our folks are going through a little quicker now, as you may notice, so I will quickly transfer it over to Christine, who's going to give you an update on our Goodwill project. Christine?
Thanks, Rich, and I'll be brief. So subsequent accounting for goodwill is a project that we added to the agenda in response to feedback that we have received over an extended period of time with respect to concerns around the impairment model. So we've heard from preparers that it's costly. We know that it's an area of high risk for auditors. And we've also gotten mixed feedback from users regarding the benefits of the impairment model. It's also been an area that's been quite costly from a standard setting perspective as well. You may recall that over the years, we've issued a number of standards related to goodwill in an attempt to try to reduce the cost of the impairment model, including the standard that introduced step 0, the qualitative assessment, a standard that eliminated step 2, a private company exception that allows private companies to opt to amortize goodwill, and if they amortize, to incorporate certain other indefinite-lived intangibles into the goodwill balance as opposed to recognizing them on a separate basis. And we recently extended that that exception to not-for-profits as well. So a lot of standard setting activity over the years related to the model. So there is evidence to suggest that there may be a cost-benefit imbalance in this area of the guidance, which is why we decided to add this project to our agenda. Staff issued an invitation to comment last July 2019, so a year ago July, and we received approximately 100 comment letters in response. So that feedback was greatly appreciated, very helpful to us. Staff has continued to conduct outreach, and we also had 2 roundtables in November. So we've been getting a lot of input into this, which has been, as I said, very useful. July 15th was our most recent board meeting where we continued to discuss the project, received an update from the staff on all of that outreach that we had conducted. And we decided at that point to continue to request that the staff continue to work on the amortization model, and also to consider whether there are any additional changes that could be made to the impairment model, provided that we have an amortization model. So to look at those 2 things in concert. So we're waiting for the staff to come back, which they will at some point in time, and project is continuing.
Great, thank you, Christine. Hal, do you want to, sorry, Tracy, were you going to jump in?
Yeah, if I could just ask a question of Christine, Rich. I know at this meeting last year, you folks indicated that at least some of the feedback you were getting from some users was that the impairment charge wasn't really providing them with decision useful information. I'm curious, as we talk today, are you still hearing that from significant numbers of users? And do you think their answer would be any different if there was more information disclosed about the charge, where management has determined the fair value of a reporting unit and how that might impact what the stock is worth, et cetera?
Right. So the feedback that we get from users kind of falls into 3 buckets. There are definitely those users who feel that the impairment charge does convey decision useful information, and they are satisfied with the current model. Then we have another group of users that say, yeah, they get some benefit from seeing the impairment charge, that it tends to be more confirmatory than, you know, sort of a piece of new information. But they also recognize that there's a cost in the system related to the model, and they're not sure that the benefit that they receive justifies the cost. And then there's the third group of users that says, look, it's our job to determine firm value, forecast future cash flows. We don't pay any attention to the goodwill balance or impairment charges because we're doing our own assessment, and on that basis making a determination as to the value of the entity. One other piece of feedback that we've gotten from users is that users suggest that the impairment charges are most informative when they happen in the near term following an acquisition. So if there's an impairment in the first 3 to 5 years, that's much more informative to them than if they see an impairment happening in the 10 to 20 years after an acquisition happens. So it also seems to be somewhat time sensitive.
In the interest of time, I know Alicia was going to give a brief update on asset acquisitions and BizCom, but it's pretty early in the process. So with that, I'm going to turn it over to Hal, who's going to bring us to conclusion on 2 topics. So Hal, this is your chance to close.
60 seconds or less. Thanks, Rich. No pressure whatsoever. Rich, early on, you mentioned unnecessary complexity. And I think this is a great way to kind of sum this up. Liabilities and equity, in my 9 years plus on the board, is a great example of unnecessary complexity. We issued standard, they issued 2020-6, which addresses, the convertible instruments and contracts and equity in entities' own equity instruments. I'm not going to go through all the details there. It would take us forever to get through it, but I am going to do a shameless plug for our website, not unlike what Rich did earlier on, but if you can see it right there, FASB in focus, you can go on our website. Everything we've talked about today has got a good plain English summary of it and talks about, what does it do? Why did we do it? In this case, we issued it because there were a tremendous number of restatements going on. And frankly, the investors were confused. They didn't understand. There were just form over substance types of outcomes. So instead of going through all that detail, if you're interested in the topic, go to the FASB website, FASB in Focus, and again, reference rate reform and other topics as well. I will point out one item though. The standard goes effective for the first round, the PBEs minus the smaller reporting companies. It goes effective in 2022, for everyone else 2024. We did provide though an option for early adoption in 2021. And I mention this is because if we really did our job here, we're going to actually take cost out of the system. We're going to make it simpler. And so early adoption in this standard may actually be very helpful. So I'd get the word out as much as possible, point them to the website, point them to FASB and Focus on this topic and others, and mention that, you know, it may be worth a little time and effort to spend looking at this because it could actually be much easier for them. And I'll just stop there on that topic. Rich, did you want me to touch on the last item as well?
Yes, please, Hal.
Okay. I just noticed in the last item, you talked about electronic reporting, a topic near and dear to my heart. As a former investor, I hated taking information off of a website and having to key it in. And anything that we can do collectively as an organization, whether it's the FASB, GASB, anything we can do to look at the production, distribution, and consumption of information and look at that complete supply chain, if you will, financial reporting, is something that is long overdue. I have some really long speeches on this topic, but I think that, you know, I think if nothing else, in the environment we're in, everyone's going to be very receptive to listening to ideas. I have a lot of ideas here, so if on another meeting of the two groups, we can certainly sit down and talk about this in more detail. But one of the more frustrating things is the repetition of information that could easily be linked from one document to another without going through. And I talk quite often about a document room or a reference room. Instead of having paper-based financial statements, we could have a room on the web that has all the information and links between it. We can talk at length about auditing issues around that and how you build controls around it. This is not a new idea. It's used in M&A projects all the time. And you can actually see who's using information, when it's used, when it's updated. There are a lot of benefits, a topic that deserves at least its own multiple-hour session on it. So I'll just end there. You have at least one board member who's very receptive to talking about this idea.
And I can vouch, Hal has a lot of ideas. So definitely listen to them. They're great. And we find them very helpful. So I'm sure you will too. Hey, Tracy, before I turn it over to you, I just want to say, I think the fact that we ran full time is just, is a perfect representation of our interest in working with your group. I appreciate it. Thank you all for coming today. And I'll turn it over to you, Tracy, for last words.
Well, I would echo yours, Rich. This has been very helpful for us. I feel kind of badly that we rushed some folks toward the end. I guess one of my takeaways is maybe fewer topics, a little deeper going forward. But also, I hope we can keep, I know we're both doing outreach, and so let's keep thinking of if there are additional ways that we can work together. You know, Hal's topic on electronic reporting, of course, has accounting and auditing ramifications. So maybe it's something that a small group of folks, both FASB and AICPA ASB related, could dive into at some point. We'd be very interested in that. And as I mentioned, it's consistent with our strategy as well. So thank you very much. Greatly appreciate it. Thanks to everybody for your participation, and I look forward to continuing our dialogue.
Great. Thanks, everybody.